Silver just crossed a technical threshold that hasn't been breached in over a decade. And it happened in the middle of a Federal Reserve pivot. Most analysts aren't properly connecting to commodity markets. While equity traders were focused on rate cut speculation and bond yields, silver spiked through resistance levels that have held since 2012, moving with a velocity that suggests something structural has shifted. This isn't about a single catalyst. It's about three separate pressure systems converging at the exact moment when industrial demand, monetary policy, and supply chain disruption are all pointing in the same direction. The question isn't whether silver is overheating. The question is whether the market has correctly priced what happens when the Fed eases into a supply-constrained commodity while the world's largest producer suddenly goes offline. Most people are still watching this like it's a speculative trade. It's not. This is a repricing event. If you want to understand what is actually driving these moves before the narrative gets sanitized by mainstream coverage, make sure you're subscribed. Most financial media won't connect these dots until the move is already over, and by then, the institutional positioning will have already shifted. This video is educational content only and does not constitute financial advice. All analysis is based on publicly available data and broader market observation. Always consult a licensed professional before making investment decisions. Silver's recent breakout above $32 per ounce didn't happen in isolation. It happened during a week when the Federal Reserve signaled a dovish tilt in forward guidance. Chinese mining operations reported unexpected production halts, and industrial silver demand data from solar panel manufacturers showed a year-over-year increase that exceeded forecasts by nearly 18%. Each of these factors alone would be notable. Together, they create a configuration that hasn't existed in modern commodity markets. The last time silver experienced this kind of technical momentum combined with fundamental supply pressure was in early 2011, right before it briefly touched $50. But this cycle is different, and understanding why requires looking at what's changed in the structure of silver demand over the last 15 years. The Federal Reserve's shift toward rate cuts is being interpreted primarily through the lens of equity valuations and credit markets. That's a mistake. Precious metals, particularly silver, respond to real interest rate expectations, not nominal rates. And when the Fed cuts while inflation expectations remain sticky, real yields compress. That compression makes non-yielding assets like silver relatively more attractive, but it also signals something deeper. Central banks are prioritizing growth and employment over inflation control. That's a regime shift. It tells you the Fed is more concerned about economic fragility than price stability, and historically, that environment has been extraordinarily bullish for monetary metals. Silver benefits from this dynamic more than gold because it carries a dual identity. It's both a monetary asset and an industrial commodity, which means it captures flows from investors seeking inflation protection while simultaneously benefiting from manufacturing demand that accelerates during economic expansion. China's role in this equation is being underestimated. The country produces roughly 16% of the world's mined silver, and recent reports indicate that environmental crackdowns and regulatory enforcement have led to temporary closures at several major facilities in Henan and Yunnan provinces. These aren't minor operations. We're talking about output that, when aggregated, represents nearly 4 million ounces of annual production. When that supply exits the market without warning, it doesn't just tighten the physical balance. It forces industrial buyers, who rely on just-in-time delivery models, to compete for shrinking inventory. That competition shows up as price. It also shows up as backwardation in futures contracts, where near-term delivery commands a premium over deferred months. That structure tells you something critical. The market is pricing in immediate scarcity, not future abundance. The solar industry is consuming silver at a rate that most commodity analysts didn't anticipate 5 years ago. Each photovoltaic panel requires approximately 20 grams of silver, and global solar installations are projected to exceed 400 gigawatts this year. That translates to roughly 130 million ounces of silver demand from solar alone, which is nearly 15% of total annual mine supply. This demand is structural, not cyclical. Governments around the world have embedded renewable energy targets into long-term policy frameworks, which means this consumption isn't going to reverse if economic growth slows. It's locked in. And because silver is a critical input with no commercially viable substitute at scale, manufacturers have no choice but to pay the prevailing price. That creates a price floor that didn't exist a decade ago. What's particularly interesting is how institutional positioning has evolved. Large speculators in the futures market have been reducing their net short positions steadily over the past 6 weeks, while managed money has been adding length. That divergence suggests that commercial hedgers, who are typically short because they produce or process silver, are covering their hedges because they expect higher prices or tighter supply. Meanwhile, investment funds are building positions because they see momentum and fundamental support converging. This isn't retail speculation driving the move. It's sophisticated capital recognizing a structural shift before it becomes consensus. The ratio between gold and silver has compressed from 90 ounces of silver per ounce of gold down to roughly 83. That might not sound dramatic, but in percentage terms, it represents a significant revaluation of silver relative to gold. Historically, when this ratio compresses below 80, it signals that silver is outperforming on both momentum and fundamentals. It also suggests that investors are moving beyond safe haven psychology and starting to price in industrial demand dynamics. Gold is a pure monetary asset. Silver is a hybrid. When the ratio compresses, it means the market is assigning value to that hybrid status, which only happens when industrial demand expectations are rising faster than monetary demand. That's exactly what we're seeing now. The $65 to $70 price target being discussed in some analytical circles isn't based on extrapolation. It's based on what happens when you model a supply deficit of 50 million ounces against inelastic demand and declining above-ground inventories. The math is straightforward. If mine supply stays flat or declines due to operational disruptions, and if industrial demand continues growing at mid-single-digit rates, then the only variable left to balance the equation is price. The market will clear, but it will clear at a higher equilibrium. How much higher depends on how quickly new supply can be brought online and whether demand growth moderates. Neither of those things is likely to happen in the next 6 months. New mines take years to develop, and industrial demand is locked into multi-year contracts and regulatory mandates. What retail investors often miss is that commodity rallies don't move in straight lines. They move in waves with sharp corrections that shake out weak hands before the next leg higher. Silver's volatility is twice that of gold, which means a 5% pullback can happen in a single session without invalidating the broader trend. Professional traders understand this. They use volatility to accumulate positions during dips rather than panicking when price retraces. The key is distinguishing between a technical correction within an uptrend and a reversal of the underlying structure. Right now, the structure remains intact. Support levels are holding, volume is confirming price moves, and the fundamental drivers haven't changed. Central bank behavior is another factor that's being overlooked. While Western central banks are cutting rates, emerging market central banks have been accumulating gold and, in some cases, silver as part of reserve diversification strategies. This isn't publicized widely because reserve managers don't broadcast their positioning, but flow data from refineries and vault operators suggests that non-Western official sector demand has been quietly increasing. That demand adds a layer of support beneath the market that wasn't present in previous cycles. It also signals that large institutional players with long-time horizons view precious metals as strategic assets, not tactical trades. The narrative around silver has shifted from speculative enthusiasm to strategic necessity. 5 years ago, silver was viewed primarily as a derivative play on gold or a momentum trade for risk-tolerant investors. Today, it's being discussed in the context of energy transition, supply chain security, and monetary policy divergence. That shift in framing matters because it attracts a different kind of capital. Pension funds, sovereign wealth funds, and corporate treasuries don't chase momentum. They allocate to assets that serve a strategic function within a diversified portfolio. Silver is increasingly being recognized as one of those assets, and that recognition is driving flows that are larger and stickier than retail speculation. The comparison to 2011 is inevitable, but it's also incomplete. In 2011, silver rallied on monetary fear and speculative fervor, with limited industrial demand growth to support the move. When sentiment shifted, the price collapsed because there was no fundamental floor. This time, the floor exists. Industrial demand is real, measurable, and growing. Supply constraints are documented and worsening. Monetary policy is accommodative, and geopolitical risk is elevating safe haven demand. Those are conditions that support sustained price appreciation, not a parabolic spike followed by a crash. The risk isn't that silver goes to 70 and then collapses. The risk is that it takes longer to get there than the most optimistic forecasts suggest, and that the path includes corrections that test conviction. Timing is everything in commodity markets. The current setup favors those who entered positions before the consensus shifted. The challenge is that once a move becomes obvious, the risk-reward ratio deteriorates. The best entries happen when the data is clear, but the narrative hasn't caught up. Right now, we're in that transition zone where the data is undeniable, but the broader market is still processing what it means. That creates opportunity, but it also requires discipline. Chasing price after a 20% move is different from building a position when the setup is forming. The professionals understood this 6 weeks ago. The question is whether retail participants will recognize it before the next leg higher begins. The most important moves in markets are rarely the loud ones. They happen in the quiet accumulation phase, long before headlines start asking whether a breakout is sustainable. By the time analysts are debating whether silver can reach $70, the institutional positioning will have already been set. What matters now isn't predicting the exact peak. It's understanding whether the structural conditions that are driving this move are temporary or persistent. Everything we're seeing suggests persistence. The supply constraints aren't resolving quickly. The demand growth isn't slowing. The monetary backdrop isn't tightening. Those are the facts. How the market prices those facts in the weeks ahead will determine whether this rally extends or consolidates. But the setup is no longer speculative. It's structural, and that changes everything.